Your 50s and 60s are important financial decades in your life.
It's generally when you have the most earning power. It's when you can still make changes, and it's when the mistakes can be costly.
I'm Jerry.
I'm April. Today we're talking through 5 financial mistakes we see couples make in their 50s and 60s and how to avoid them.
The first mistake is claiming Social Security without fully understanding what you're giving up.
We see this often. Someone retires at 62 and claims Social Security. And there can be good reasons to do that.
But here's what many people don't realize. By claiming at 62, instead of waiting until your full retirement age, or even 70, you're accepting a permanently lower benefit.
For a couple, the higher earners benefit is especially important because when one spouse passes away, their surviving spouse keeps the higher of the two benefits.
So if the higher earner claims early and locks in a lower benefit, the survivor will receive that lower benefit for the rest of their life.
What to consider? Run the numbers for different claiming strategies. Look at how delaying Social Security while drawing from retirement accounts might save you taxes and increase your lifetime income.
Social Security is one of the most important retirement decisions you'll make. Make sure you understand the full picture before you claim.
The second mistake is when one spouse retires and the other keeps working and they don't coordinate health insurance.
Here's what happens. One of you retires at 62. You're no longer on employer health insurance, but you're not eligible for Medicare.
That 3-year gap can cost significant money per month, depending on your health and where you live.
We've seen people who retired without realizing what health insurance would actually cost, and suddenly they're spending a substantial amount on coverage.
What to do instead? Factor health care costs into your retirement budget before you retire. Consider staying on a working spouse's plan if possible. Look at COBRA versus Marketplace plan. Plan for that gap.
This is one of the biggest surprises for early retirees, but it doesn't have to be.
The third mistake is not planning for required minimum distributions or RMDs.
When you begin your RMDs, the government requires you to start withdrawing money from traditional IRAs and 401ks, whether you need the money or not.
And those withdrawals can push you into higher tax brackets, increase your Medicare premiums, and cause more of your Social Security to be taxed.
We've seen people's tax bills increase substantially when RMDs start.
What makes this challenging is that by the time RMDs begin, you have limited options.
The time to plan is earlier. Your high income earning years may be in your 40s and 50s. That's when you can strategically fill up 3 buckets: taxable accounts, tax-free Roth accounts, and tax-deferred accounts.
In the years before RMDs start, you can do strategic Roth conversions to reduce the future tax impact.
The sooner you start planning, the more options you have, and the more you can potentially save over your retirement. The fourth mistake is assuming Medicare will cover everything.
Medicare is not free health care. There are premiums, deductibles, co-pays, and Medicare doesn't cover dental, vision, hearing, or long-term care.
Recent estimates suggest a typical couple retiring today might need several $100,000 just for health care over the course of their retirement.
That's not including long-term care. If one of you needs nursing home care or extended in-home care, that can be another significant expense.
We've seen people with solid retirement plans that didn't account for health care costs. And a few years into retirement, they're concerned about money because they're spending far more than they expected.
So what to do instead? Build realistic healthcare costs into your retirement budget. Consider long-term care insurance or plan for self-funding care. Understand what Medicare does and doesn't cover before you retire.
This is one of the biggest retirement expenses. Plan for it.
The fifth mistake is having estate documents that don't reflect your current wishes or your current family situation.
Your will might say one thing, but your beneficiary designations on retirement accounts and life insurance might say something completely different.
And here's the thing. Beneficiary designation override your will.
We've seen situations where someone got remarried, updated their will, but forgot to update the beneficiaries on their 401k. When they passed away, the money went to their ex-spouse instead of their current spouse or kids.
Or we see blended families where the estate plan doesn't address the complexity of children from different marriages. And after someone passes, the family ends up in unnecessary conflict.
What to do instead? Review your estate documents and beneficiary designations every few years, especially after major life changes, marriage, divorce, birth of children or grandchildren.
Make sure your documents reflect your current wishes. And if you're in a blended family, work with someone who understands that complexity.
Because the worst time to discover a problem with your estate plan is after someone has passed away.
Here's the good news.
Every one of these mistakes is preventable.
If you are in your 50s or early 60s, you still have time to course correct.
You can optimize your Social Security strategy. You can plan for health care costs. You can do strategic tax planning. You can coordinate retirement timing. You can update your estate documents.
What it requires is being intentional, and it often requires help.
If you saw yourself in any of these 5 mistakes, you're not alone.
These are the most common patterns we see. As part of our daily work, we help people navigate them.
Schedule a complimentary Connect call with us using the link in the description.
In that call, we'll discuss your situation and see if we're a good fit to work together.
No obligation, no pressure, just a conversation to see if it makes sense to further explore your situation together for what you're trying to accomplish.
Schedule your Connect call using the link in the description.
I'm Jerry.
I'm April. If this helped you identify something you need to address, subscribe and share it with someone in their 50s or 60s. We're White Oak Planning, helping families feel financial clarity and confidence.